Hello everyone. I wanted to put together a short video with a few examples on progressive exposure. This is probably one of the most important lessons I've learned from Mark Minervini. And the whole concept of progressive exposure, if you boil it down, it's basically trading the largest when you're trading your best, and trading the smallest when you're trading your poorest. Now, it may not only be you, it may be market conditions. So if the market conditions are not great, you want to be trading small. If the market conditions are good and you're seeing the setups and you're buying the right positions at the right place with the right risk points, then by all means, put on exposure. I think a lot of mistakes that I made in the beginning, and I see a lot of traders do that as well, is it's black and white, it's all or nothing. And the ability to be incremental, I think, is where the real art lies. And talking to many professional traders, they all are very incremental. They scale in, they scale out, they scale back in. So let's talk about progressive exposure on this. Again, this is not, I'm not really talking about the setup. This could be any name, any setup, but I just have a symbol on the screen. So I'm going to bring my sample spreadsheet over, and we're going to say, okay, we're going to look at TVTX. So we'll say TVTX, and we want to buy this name coming out of the high of this day, for example. So the high of this day is 1960. So I'll put in a buy price of 1960 in my spreadsheet. And for this example, this portfolio has a $10,000 portfolio size, so a max stop of $125. So I say, okay, so how do we scale in? Well, maybe I'm coming from cash, or I'm not enamored with the setup. It's not the most crisp setup. The volume's not shrinking. It's not the most perfect VCP, but I want to take a chance and let's see if this could work. So I could start with a quarter position, which are 32 shares. Okay, and let's just say that a logical stop for me here would be, let's say, the low of this little handle, if you will. So somewhere around here. And that's just, I'm testing the waters, right? Like, I just want to test the waters. Let's call it 1905. So I put in a stop of 1905. Great. I'm risking nothing here, right? On a $10,000 account, about a quarter position. Total outlay is $627. 2.8% risk on the trade. However, total account risk under 0.2%, which is nothing. And as we know, our max percent is 1.25 as per Mark's books. But I'm just testing the water. I'm just seeing what's going on here. Now, let's say that I buy the stock. Great. And make that a little bit bigger. So let's say now I buy it, and we have a nice, it opens up as an inside day. And I say to myself, hey, if it passes this point, and I'll just make that a different color. Let's say it passes this point of, maybe that's some type of resistance for me, I will add to the position. Because what's happening now is that I'm progressively getting into the stock, right? So I'm saying, hey, let's try it. Rather than saying, you know what, I'm going to put my entire position here or here. I put some of it on there, and then I say, you know what, I'm going to put another piece on if it comes through this line. So for example, whatever that is, that's 1980. Okay, so if we go back to the spreadsheet, I'll say now I'll put TVTX TX, and now maybe 1980, and maybe I'll bump it to a half position, or maybe I'll add a half, right? So I can say, here, listen, it's given me some indication that it's moving the right way, and I can use the same stop, right? So I'm still trading very small, right? Like together, I'm half of the maximum account risk. So Mark always talks about 1.25% of total account risk on any given trade. I'm here at like 0.6, right? So half of that. So now I could add another position here. So I have a small position that I bought here and a small position that I bought there. So now I've moved in with basically a 3/4 position, and I've done that progressively. There's a couple other examples that I want to talk about, but that's one way to use progressive exposure. Like, let the stock give you some indication that it's working for you, rather than going across here. Now, some of you traders who are not full-time, this can be done by buy stop orders, right? You could put a couple buy stop orders and I really encourage you guys to look at conditional orders. I may do a tutorial with that down the road, where basically I can put an order in because I'm not in front of the market. I have a full-time job. I'm in a different time zone. I can put in a buy stop order with a condition that says, hey, if it hits this price, do this. If it hits another price, do this. So now basically I've been scaling in, very small. So I said, hey, I scaled in, and then I started scaling into my position. Now, if this thing breaks out of here, for example, and we're saying we're in new high ground, well, I could then add, and we'll talk about that. Let's just say that we're breaking out of the high of this, for example, and not that I would necessarily buy it like that, but let's just say TVTX, and I'll put here 1999. So, and I'll put another 1/4 position on, right? So we have 31, and I'll just leave my same stop, for example, and we'll talk about that in a moment. But now I can add, basically what I've done is I've built a full position, but on success or on progress of the name. I'm watching it, it's gone up a few percent, and I slowly built my position. Now, again, does that change your average price? Yeah, for sure it does, but 1960, 1980, 1999, there's not a big difference there. But the main thing was that I was progressively scaling in, progressively being incremental. So that's one example on how to scale in using progressive exposure. So continuing with the theme of being incremental, you have some options now that the stock went up. So I tend to, my plan tends to be to go in very tight at the beginning and see that I don't get some quick pullback or something, and then adjust to a normal risk as per my plan. Now, I want to be very clear here. I'm not advocating changing your plan midstream, right? You should have already understood what you want to do right from the beginning. So let's say my plan was come in with some tight stops, very small positions, and then see if the stock moves my way, and then I can then put in what my proper risk could be. So what I could do is also put in some staggered stops now. So say, okay, wherever I am now, put a stop at 1, 2, and 3%, for example. So sell off 1/3 of the stocks at 1%, 1/3 of the stocks at 2%, 1/3 of the stocks at 3%. And the idea is that, let's say it goes down 1%. So you sell off 1/3. So a couple things have happened, right? You've reduced your risk because now you've sold off some of it, so you reduce your potential loss. But let's say it turns around and goes back. Well, you could just buy that portion, that 1/3 right back if it goes right back up again. So this is not a black and white all or nothing. Let's just say you bought, X number of shares. You sell off a third at 1% if it drops. If it drops 2%, sell off another third. If it drops 3%, you sold everything. But if it goes down 2% and then goes back up again, you can put it right back on and then have the same full position by peeling back some and then re-adding. This is something I think that a lot of new traders struggle with. I did, for sure. Everything was put it on and wait, as opposed to peeling back and adding more. So let's continue on the progressive exposure idea. So let's say you're coming from cash, or you've had a few hits, you've gotten stopped out, and we all know that, like, as much as we like to say, hey, it's 50-50, losses and wins don't come 50-50. Sometimes you'll get 4, 5, 6 losses in a row before you start getting a couple wins. And that should cause you to trade a lot smaller. So again, when you're doing your best, you're trading your largest, and when you're doing your poorest, you're trading your smallest. So if we come here and we say, let's say this example stock again, TVTX, I want to buy it at 1960. So I say here I want a half position because I'm testing the water. I want to start with not a full position, a smaller position, because maybe I'm coming from cash, maybe I had a couple losses. And so using the math of a $10,000 account, a half position gives me 64 shares. So I say, okay, 64 shares, and I'm using a stop of $19.05. Well, $19.05 gives me a trade risk of 2.8%. So on that stock, it's just under 3%. However, total account risk is 0.35%, well below the maximum recommended 1.25 by Mark's books. So the important number here is this dollar value, right? Or the trade risk, whatever you want to use. But so to be a successful trader, you need to turn over your edge. And Mark teaches that you need to be minimum a 2-to-1 trader. What does that mean? That means if you buy something for $19.60 and you put $35.20 of risk, or 2.81%, you can't sell that stock before you make at least $70 worth of profit. Because otherwise, you're just going to churn up and churn and churn and not going to make any money. So that's how progressive exposure works. So let's just say we're coming from a string of losses, coming from cash. We'll buy this stock, and let's just say we were lucky. It's right now, this is all risk, right? We're all risk right now. We haven't made any money. We don't have any cushion. We're all risk, coming from cash, coming from a string of losses. But let's just say that this stock went up 6%, right? So it went up double my risk. So I would have a little bit more than $70 of profit. So what could I do then? Then I could say, okay, well, if I have $70 worth of profit, I'm going to buy ABC stock and, XYZ stock. And I'll say, okay, this stock is 25.42. I'm just putting some bogus numbers. And this stock is 34.50. Again, it doesn't matter what the stock number is. So then now what do? Is I say, okay, let's look at a half position here. And I'm just going to use some simple math and my preset math. I'm just going to set the amounts that we have. So I'm going to say, okay, let's just say we're going to put a 3% stop on each of them. So my spreadsheet already does that math for us. I'm getting that from here. So you'll notice that we're very close. So what am I trying to do? So basically the scenario was that I bought this stock. It went more than 2-to-1, meaning I risked $35 and it passed $70 in profit. Well, what that allows me to do is that now I have $70 in cushion, and that's where I use this progressive exposure. So once I would have sold this, I go into here and I put in progressive exposure, and I would say, TVTX, let's say I sold it and I made $75. And this is something that I just use it here as a shortcut. So now these two stocks together are just under $75 of risk. So that means if both of these stocks stop me out, I would be in the exact same place I was when I bought this first one of TVTX, because I'm back to zero again. However, now I have two opportunities to make money, and I'm using the gains from my previous sale to finance the risk on the next stock. Now I could have done that, or I could have said, hey, you know what? I'm going to buy a 25% position, which is 74, and just bought one stock, because regardless, it's the exact same thing, right? Because if this stock, TVTX, when I sold it for 2 to 1, I made $75 of profit. Well, I can now comfortably buy, progressively add exposure using the financing that I did with the previous stock. So now I'm using those $75 of risk. And if I get stopped out, great, I'm back to zero. However, if I sold it again at 2 to 1, well, now I'm making $150. And I can buy 2 more shares of 2 full positions or 4 half positions, whatever you like. So there's a couple ways to do this, right? So you can scale in or as like from a low cheat or something in a base, or a low risk entry, and try a very small position. Does the stock move in your direction? Great. You can add to it and build your position rather than going in full. Same thing with if you see 3 or 4 names, but you're coming off a string of losses, or you don't have any cushion, don't right away put 3 names on. Put 1. Let that work for you. Let that use that money to finance your risk. You're slightly building up your account, and then that way, for example, just to give you an example, you see here, let's say I made $75 here. Well, I would have gone to my portfolio and I would have added $75. Now you see that makes my portfolio size, and it makes it slightly bigger. Okay, it adds $1, but as you keep adding small amounts of money, then your position sizing becomes a little bigger. It's still the same 25% position, but you're buying with a bigger shovel. So this is something that has really, really, it was a big change for me, because I would be getting into positions and then giving it all back, or moving to fully invest it too quick. I made some money, but I over invested based on my gains, so I put more risk on than I had of cushion, and I would just keep yo-yoing around. Like, I would get some gains, give it all back. Get some gains, or worse, go into minus. I hope this is helpful, and if you guys want to ask any questions, you can put them in the comments.